Hey everyone, welcome back to the download with Joe. Hope everyone's had a good week. We're doing this virtually, unfortunately, just because Joe and I live, 4,000 or 5,000 miles apart. Um,
Must
but
be.
great, yeah, at least. Great to get some feedback from everyone that tuned in. And if you're tuning in again, then we really appreciate the support. There is likely to be some technical difficulties and some fine tuning as we build momentum on this series. So yeah, appreciate your patience on that. Um, as always, joined by Joe. Joe, do you want to quickly introduce yourself again for those who didn't tune
Yeah.
in last week?
Yeah. Thanks, Lewis. And I figure the technical difficulties will likely go down as we do this more. But Joe Amador provide fractional head of product type services for vendors focused on digitization and decarbonization of real estate assets. So that can be large and small vendors, that can be investors, private equity, venture capital, and do a little bit of work and maintain a pretty robust network of the owners and operators who are using these technologies. Uh, Only other thing to note, I have a newsletter I publish every month. It does a wrap up of, among other things, the M&A activity and then the financing from early stage companies. And we'll, on these sessions, talk through on a weekly basis one of those pieces. So today, I think we're talking about financings.
We are indeed. We've obviously got quite a lot to get through, despite what's been a pretty challenging year when it comes to VC activity, and I'm sure we'll touch on that very quickly. We were at Realcom last week. What's
Yeah.
some of the biggest takeaways for you, Joe?
Yeah, between the takeaways that I had and the takeaways that I was reading on LinkedIn, because there's been, at least within our network, quite a lot of posts. Um, I think that there was, on one hand, a little bit more realism of just the state of the real estate market, especially in office. So just in one-on-one conversations with individuals, I heard things like, we're just not planning to build more offices, or we just have a challenge on the office side. But a lot of enthusiasm and investment around multifamily, some retail, a lot of multi-use. So buildings that have or portfolio or properties that have a combination of things, some retail, some office, some people living there. And then industrial warehouse, of course, a lot of enthusiasm. So that was interesting. There was definitely much more discussion around AI. And I would say I'm very high on the opportunity around AI, but I would also say I'm a little skeptical of just the individual technologies being delivered. But they did have this nice showcase. They always do this at Realcom, but they had a nice showcase on, I think, Friday morning. You could go and talk to individuals about individual projects. And when you talk to them, I would say that there's actual technology being deployed. I guess if you actually talk to an expert in AI, they might say, well, is that machine learning? Is that AI? But that's really at the cutting edge or the leading edge of the more sophisticated real estate owners and operators. They're definitely upping their game, if you will, around the technology they're using. And there are clearly a lot of use cases for AI. I think far beyond even what we'll talk about, because from a leasing point of view, from a construction point of view, from a design point of view, I've seen a lot of really interesting use cases, just not exactly our cup of tea, if you will.
I'm not a technical expert. I think I pride myself in being relatively dangerous enough to hold decent conversations in the space, but it feels to me anyway that we're still quite some way or quite a long time away from actually getting the most value out of AI. Um, at least, and this is just the feedback that I got from Realcom. I think there's more pressing priorities for the industry, and obviously we touched on last week about data. I
Right.
think there's obviously other aspects that need to be improved before you get really good outcomes from artificial intelligence.
I agree. And this came up, I think a lot of the good examples that I saw were individual buildings. And that's where you would expect things to start, right? We have a building. I've been to other conferences specific on AI, and some of the examples I've heard are, well, we picked 2 buildings or we picked 5 buildings to trial an AI powered or AI driven solution. And a big part of that is the time it takes to deploy, the time it takes to use that new solution. You also have this shortage of labor. So while a solution that is AI powered long term, I think will augment staff and help you with the labor shortage issue. In the short term, it might just be a new thing, new technology, a new solution somebody has to learn, and maybe there isn't a clear person to be that learner. So that can be an issue. But I think the data readiness piece is also one that came up here at Realcom, and I'll give them credit for making sure that came up. But it's not just plug and play. And I think that's also one of the reasons why it will be a slower path to adoption. If you have, we'll talk about some of the companies that have raised money, but if you're looking to do a capital plan for a lot of real estate assets, that just is when you're replacing equipment, what you're spending money on, the capital you're going to spend. A first step there is to know, what do you have today? And in many cases, that's a challenge. It's paper-based, it's not centralized. There are a lot of ways AI can help there, but you could argue that you probably need some base level of understanding even before you can deploy those AI-powered solutions.
Not sure whether I lost you there, Joe, but no, I completely agree. We've only got a small amount of time here, so let's jump into today's topic, which again is all about VC activity. And I don't think it would be a shock to anyone that it's been a relatively slow, 12 to 18 months in terms of activity across the VC space. Deals are harder to come by and close. There's a lot of question marks about where this industry is going, and whether VC can actually have an impact in this space. But there are some deals that we're going to speak about which are pretty interesting, and I think it's useful or beneficial for everyone if we start with industrial, just because, and it's industrial with an N, not the industry, and then we can go from there. I mean, what's your thoughts on that one? Because it's a pretty big raise, isn't it?
Yeah, so industrial, no I at the beginning, as you said, they raised a Series B, 18.5 million. The two lead investors were GS Energy. GS is a large, I would describe as conglomerate, South Korea. They're involved in battery production. They're involved in a lot of industries. They would look a little bit like a Samsung or an LG, just in different places. And then ABB, and ABB is also very interesting. Obviously, a huge company, look a lot like a Siemens. They're just less of a presence in the United States. But they, for example, are a major investor in Brainbox, so they are influential here. They were the two lead investors. NG New Ventures is one of the existing ventures that invested as well. Industrial is interesting. There are not that many companies that are focused on energy efficiency in industrial assets, and they're really going after not industrial like a warehouse, which sometimes when you hear people talk about industrial, they really mean a warehouse. Very simple building, typically, maybe not even conditioned air on the inside, so HVAC is not a huge issue for them. But industrial assets like factories, foundries, just heavy in industry, there's a lot of opportunity there. They use a lot of energy. They are buildings, but they're not exactly the same type of buildings. And industrial has done a couple of different things. They really promoted the software focus, but I've also heard them referenced as a firm that almost can provide finance or project delivery to those sites. The industrial sites also have been interesting. Historically, they're a really good target for demand response. Think of any type of facility where there's an assembly line. Well, demand response oftentimes works on the basis of don't use the energy now, use it later, or use it early. And for a building, that can be pre-cooling HVAC. In our home, we have a smart thermostat, same idea. You can pre-cool, you don't use the energy at that peak period. The time of use rates also map to that. Energy is very expensive late afternoon, early evening in most markets now because there's a lack of solar and there's a lot of people using energy still. So industrial, their play of a variety of things, right? There's a lot you can do to reduce energy consumption in those sites. Historically, demand response went there because if you delay an assembly run a few hours, you will get paid by the utility. But from that initial adoption of demand response, you didn't see a lot of firms saying, hey, we want to come here and help you with all kinds of other things, more efficient equipment, replacing equipment. You have now, for example, heat pump chillers, which provide hot and cold water. It's one piece of equipment where historically you would have needed a boiler and a chiller. A lot of industrial facilities require cold water in a lot of cases. When I worked at JCI, there were all kinds of press releases of just large factory requires chillers. So there's a lot industry can be doing, and their backers are pretty significant players in heavy industry. Absolutely ABB, absolutely NG, GS Future or GS Energy, part of the bigger GS group, also there.
Yeah, no, it's definitely an interesting play. I can't think of many organizations that we know anyway that focus specifically within industrial. So Again, it's not a business that I'm aware of. It We don't typically play in the industrial space, but they look like a an interesting business. And you were referring previously, you were referring back to like the type ESCO model where they can finance everything and then pay back in energy savings.
Exactly. Yes, and that was not as clear in this current press release, but that's something that I've heard of industrial providing, and that makes a lot of sense. Oftentimes, the biggest barrier, if you have a large facility, a factory or not, is I would upgrade the equipment sooner and reap the incremental energy benefit, but I don't have the money to do that. So then energy efficiency financing can come into play to help pull forward, if you will, those capital spend or that capital spend. And there's other companies I would say that could provide financing for industrial assets. I've heard of examples, project examples. I think industrial is a little unique in that they're really, really exclusively focused on those industrial assets. And they seem to be building a stack from financing, services, technology. I guess I should flip that around: technology, services, financing. But yes.
Cool. That's an interesting play. Um, so like I said before, it's been a challenging 12 months, 18 months for VCs. But what you're referencing there, and also with this next deal, is that there are still some pretty large names, ABB, GS, and now coming on to
Yeah.
Verse, with the likes of Google Ventures and MCJ to name a couple on that deal. So
Right.
that's pretty,
Yeah. And
that must show positive signs for the space with those type of names betting on it.
absolutely. And Co2, which very major investor across a lot of technology categories, also was involved in Verse. Verse is a little bit on the edge of, I think, where we typically focus, but they say it's an AI powered solution to buy and manage clean power. What I would generally say is, one, it was hard to really get a good sense of what's the AI here. And that's oftentimes the question I have if a new company comes to me or if an investor asks me about a company. Tell me, what's the box where AI is doing something differentiated? And I'm not saying it isn't or it is. I'm just saying getting a good answer there is probably a good question to ask. But purchasing power is becoming a bigger issue in that there's a lot more sources of power. It's less one way. It's less the utility provides you the power, you get the bill. Obviously, solar, renewables, more generally, having batteries actually does have a pretty interesting component there. And I think there's a lot of opportunity, and that can fit in asset classes, that can fit in types of power. I saw an interesting presentation a couple of weeks ago, and it kind of started to, for me, crystallize that you're going to have different solutions along the buying of, you could say, power or efficiency. And you could say, I could buy more power, I could buy more efficiency. At the end of the day, those are both having a fairly similar net benefit, right? I'm reducing my carbon impact, I'm reducing my overall energy costs, getting some more security or consistency there. And you have some solutions that are very focused on helping you find options and opportunities, right? This site is perfect for solar and you don't have any solar. I would argue it's a little bit more detailed than just doing kind of a solar study, but there are solutions that say we want to help you assess that. There's other solutions I found that help you procure, right? We can help you manage the actual proposal process with vendors, and we can tell you this vendor has never done a project in this state, so there might be an issue. These other three vendors have, and then you have the whole management. And so you have some companies doing a niche along the chain, the buying chain, and you have others that say we just want to focus on clean power, purchasing and managing. And Verse seems to be more focused on the whole life cycle. You could argue it's a seed round. There have been a lot more seed rounds. There's data that shows things are down overall in terms of funding, but a lot more seed rounds than normal. They might find there's a certain place they want to fit within that longer value chain.
Okay, it's still a pretty sizable round though, as Series A goes. What was it, $20 million?
I think Verse was just 5.75. That was still a fairly large seed round. I mean, there's been, I don't know, maybe it's partially inflation, but more generally, rounds are getting bigger. I mean, I remember 10 years ago, a Series A round for a company in kind of decarb and digitization of real estate, five to eight. You could get a
Yep.
Series B that got 10 to 15, and now I think there's a few more to discuss, but we're seeing two Series Bs. One was 18 million, one was 30 million. I think we're going to talk about those next. Those are bigger than what I would have expected 5-10 years ago. I'm not saying it's a bad thing, but generally more seed rounds, more of those 3, 5, 8 million rounds, and that's kind of where a seed round might land these days. Fewer larger rounds, but you still have a lot of capital, especially on the clean tech side, and something we've talked about. Prop tech investing is down, and there's data that we've seen that is public data, of course, it's down. Climate tech funding also down, not as much. I think where we're really focused is that intersection between them, because climate tech can include, agricultural solutions. It can include a whole host of things that are not really a building technology offering. And then prop tech, of course, includes a lot of things like construction, leasing, management of, residential real estate, which, has a lot of public comps at this point. But we're right in the middle. Both of them are down, prop tech down more, climate tech down a little less.
Agreed. Well, it'll be interesting to see how that business plays out. I think, at least from where I sit, and keen to get your thoughts here, but because of how long it takes for this change management education piece from actually, they need technology within the built environment to actually implementing that. We may see bigger rounds just because there's going to have to be additional cash that keeps them throughout the sales cycle, which can take anywhere from 12 to 18 months.
Right. I think there's a couple options you have if you're a company in that position. I think it's less of an issue for early stage companies because they haven't really yet run the playbook of sales and marketing across a relatively, consistent and large ecosystem, right? A lot of times before you're raising your seed round, you secure a couple clients, you have success with them, you show what you're doing, and then you can from there raise money and then go hire more sales and marketing, more of a professional sales team. The companies that are later that maybe ran that playbook and it worked, but it didn't work well enough, they might have trouble raising more money, but they also are in a position where they are, consistently serving clients. Those are the ones where I think there's more of a question. The other dynamics, if you raised money 5, 6 or so years ago, the funds that gave you that last round, they probably want to show some returns, and that may lead them to looking at, well, what are our strategic options for this business? So I think part of the reason why you're not seeing as many of the later stage rounds in general is that those companies maybe are trying to figure out, well, can we raise at a higher valuation? Maybe not. Do we want to return some capital back to our current shareholders? That's going to, I think, become increasingly a theme that is a yes in the coming years too.
Okay, and for those that weren't listening last week, we were speaking a lot about themes within M&A and starting to see a trend. And I think from my standpoint, what's been pleasing to see is that where traditionally our core focus is, you and I, is within that building operations element. And we've seen a couple of relatively large Series A's, Series B's within the space. I think it'd be good to bring up Parity first of all. What's your thoughts on that one?
Yeah, so Parity, and this is one that was just announced, I think, the week before Realcomm. So it's in June. It'll be in my newsletter, for example, going out in about a week and a half. So Parity, they raised a $19 million Series B. The lead investor was Idealist Capital. Existing vendors, ArcTurn, Wise Meter Solutions, RET Ventures, all joined that round. Their last round was led by RET Ventures a couple years back. RET Ventures is known as a pretty strong investor within multifamily. A lot of their LPs, or a fair number of their LPs, are multifamily owners, operators. And what Parity does is within, for now, mostly multifamily. I wouldn't say it's exclusively for multifamily. They provide what I would describe as HVAC optimization. Some public reports I've seen describe this as either automatic supervisory control or automated system optimization. But the idea is you can actually write back to the HVAC system and you can actually save energy, because HVAC is typically, let's say, 40 or so % of energy consumption. So by trimming some areas of inefficiency, ramp ups that can be more efficient, not pre-cooling a little bit so that you don't have to cool as much at the peak periods. There's a whole host of kind of scenarios in there where you can squeeze, if you will, some savings out of the HVAC system. That's what they're providing. And I believe they also guarantee those savings, or to some extent guarantee those savings, which also can be pretty compelling for multifamily. But that's core what they're providing. There's a whole bunch of energy efficiency benefits as well. You have more visibility into where you're using energy. You have more efficiency, or more visibility into areas of inefficiency. But they're unique, and I wouldn't say they're the only company that does it, but they're one of fewer companies where they're actually doing what I would describe as two-way control, collecting data from the HVAC, the control system, writing back to it to say, we're going to actually change temperatures, change set points, change the schedules, how the building is running to save you more energy based on a lot of data streams. Weather data, of course, would be one. Data from the building would be two. And I think that has been a solution that has existed for 10 plus years, like HVAC optimization, if you will, but we haven't seen a lot of companies really, really scale into it. A good example that was doing this 10 plus years ago was Building IQ for larger buildings,
Yep.
mostly chiller plants, so buildings that had, hospital, university. And they went public in Australia, and I think they're still around. They're just not really a player there. Parity seems to have a more successful trajectory. They've also picked a different asset class as their primary focus, multifamily.
Yeah, I think the signal may keep cutting out on your end, Joe.
Okay.
We've got a couple of minutes. We've got a couple of minutes left. Two of the deals I want to touch on. Assetti, they recently raised a seed round. Would be keen to get your thoughts there.
Yeah. So Assetti is an interesting one. So they raised 2.5 million. I think it's Australian dollars, but that's going to be close to 2.5 million US dollars. They largely provide asset data collection, right? As I mentioned earlier, having just a database of the information about the assets you have across a portfolio oftentimes is not well organized, might be paper-based, might not be centralized. They say it's AI powered. I feel like a lot of companies are saying it's AI powered because that's just almost like table stakes these days. But the focus, the core data set is that asset data, chillers, rooftops, could be generators, could be cooling towers, just everything that's big and heavy and expensive that can break. And there's a real need for that. They talk a lot about capital planning. It didn't look like they actually provide a full-blown capital planning solution. There are robust capabilities out there from other vendors, but this can be an input to that. The only other thing I'll note, and this touches on something I wrote about and posted earlier this week on LinkedIn, when you look at broadly, what I would describe as enterprise decarbonization analytics solutions, or going from I'm reporting every year on my current carbon impact, my current resource consumption, my current energy impact of my buildings, my portfolio, to I want to get to net zero 20 years out, let's just say, as a kind of a number where a lot of folks are aiming. There's a lot you have to do to get from point A to point B, and a big piece of that is knowing what are the pieces of equipment, what do I need to replace, when do I replace it, and what's the benefit or the ROI of doing that. I described it in this post I wrote, almost capital planning with a net zero lens. And you could argue there will be ecosystems of technologies and components in that tech stack. And Assetti is one of, not the only, but one of the companies that I think will position itself as being very strong in terms of you need to know everything we can collect in our platform for you to actually get to net zero in, let's say 20 years.
Nice. Yeah. No, I like the sound of them. Again, it's not business that I've come across yet, but fingers crossed for them over the course of the
Yeah, I was just going to say, it looks like they're mostly in Australia, but they're using some of this capital to move into the U.S. So I would imagine we will hear more about them over here stateside, and I would imagine Europe's not far behind.
Yep, that old American dream, hey. And then just finally, this was what, in mid-April, but Code Labs with their Series B, which again we would consider, especially over the last 4 or 5 years in particular, that would be a pretty large Series B. But referencing my point earlier, maybe that's what's required for companies that have a smart building software or any kind of software in this space in order to bridge the time it takes to actually make change and drive adoption of their technology in the real estate space.
Yeah, Code is an interesting one. I've known the team for a little while. Certainly, so they raised 30 million, really big Series B. compared to what we were talking about earlier. And Mavericks Private Equity, so it was a private equity firm, so hence a larger number, was the lead. But then I Squared, which was a previous investor, and TELUS being one of the telecom companies in Canada, but also does a lot more than just telecom, like a lot of telecom companies do these days. They were an existing vendor that also invested in the round. 30 million is a larger number. I think one take on that, if you look at the companies that provide energy and smart building and decarbonization software, or primarily software in commercial real estate, and that could be different asset classes, there's just a lot of companies, and I'm seeing more companies enter the market, and not a lot of companies get bought, not a lot of companies shut down. So you could argue, or you could make a case, and I haven't run all the numbers, but you can make a case it's becoming more fragmented, not less fragmented. And what that means is to really break out, to really go knock on all the doors you need to knock on, to really be aware, or for people to be aware of you, having more capital is probably a good thing. But you have to balance that with the fact that there's been a long string of companies that have raised not 30 million in a Series B, but have raised a fair bit of money and haven't really scaled where they need to scale, and then they're left with some hard decisions. I'm not at all saying that is the path Code is on. I'm just saying it has been challenging for companies to really break out, and part of that is the bigger firms, the big controls, public controls companies, public HVAC companies that have controls products. They're all making solutions, or at least publicizing solutions, that provide a lot of the same things that a Code or its peers provide. Now, that's not a decision. My point on one is better than the other. The big public companies, though, if you look at their decks every quarter, and I cover this in my newsletter, they're all talking about how big the software opportunity is, or the software-enabled opportunity is. They're all talking about all the investments they're making in technology. They all have a platform at this point, or almost all of them have a platform at this point. And they're going to win some business just by the fact that they're well-known, they're reliable, they're not going anywhere. And if you're already selling somebody a chiller from an entity, you have their control system, you have the service contract. If one company is providing all of that, it's not a real stretch to say, do you also want to buy our cloud-based software solution that has remote monitoring, has data analytics? And you could say that Code may have a better product in some cases than those products. But if you're already spending all of that share of wallet with one entity, it's just easy to add a little bit more. But that's, I think, one of the reasons why having more money, being able to really fill up and build out your resources is not a bad thing.
Great stuff. Well, I think that's all we've got time for today. Again, for those that didn't listen last week, we're going to try and keep this to around 30 minutes, either Thursday or Friday each week. Again, there's going to be learnings for Joe and I. I think we will focus on making the quality better for next week. But we appreciate your time. If you've got any comments, questions, or queries, then please reach out to Joe and myself. We'll leave our contact details on LinkedIn for you both. And next week, Joe, we're discussing partnerships, right?
I think the goal is partnerships next week, and we'll do a rotation every month. So 4 or so weeks from now, we'll come back to funding rounds. So, yep.
Well, yeah. Fingers crossed there's a few more funding rounds. Otherwise, we won't need 30 minutes.
We'll figure out that. If that's a problem, we'll figure it out when we come to it.
Yeah. Well, Joe, appreciate your time as always. Thanks for tuning in, everyone.
Thanks, Lewis. Have a good weekend, everyone.